Hello, and welcome back, macroeconomic students. We're talking about money and monetary policy today. It's going to be fun. We're going to learn a little bit about how banks work and how they can affect, manipulate, alter, whatever word you want to use, the economy through monetary policy, through banking. So, how does the federal government affect the economy? So how does it change? If we're in a recession, what can the federal government do? If we're in an inflationary boom, what can the government do to slow that down? So how can it speed up the economy? How can it slow it down? Before we looked at fiscal policy, now we're going to look at monetary policy, right? We're going to look at reserve ratios, discount rates, and open market operations. Those are the three shifters of the money supply, right? That graph that we looked at earlier. So let's take a quick look at that again to review. So the three shifters of the money supply. So the Fed adjusts the money supply by changing any one of the following or doing anything with all three of them at the same time, right? So they're constantly doing this. One is setting reserve requirements. We'll talk about those in a second. Number two is lending money to banks, what we call the discount rate. And open market operations, buying and selling bonds. Now, the Federal Reserve is the banker's bank, right? People do not bank at the Federal Reserve Bank. Banks bank at the Federal Reserve. It is the lender of last resort. And so they kind of they are kind of the overseer of how banks are operating, but at the same time, they kind of want to and people would argue with this statement, right? They kind of want to, let banks do their thing, and then they'll come in and alter that when they need to. But they're constantly affecting how banks work and interest rates and et cetera, et cetera. So, let's get into this. So let's review those graphs, right? We saw the money supply. So when we look at this three-step transmission, right, we see that if the Fed were to increase the money supply, and how does it increase the money supply? Well, we just said, right? We just talked about open market operations, we talked about the discount rate, and we talked about reserve ratios. That's how it's going to either move this money supply and increase it or decrease it. So let's say that the Federal Reserve increases the money supply to stimulate the economy, right? So interest rates decrease, investment increases, and aggregate demand and GDP, right, and price level increase, right? So we have this movement right over here, right? You see that, right? Money supply increases, interest rates go down, the quantity of investments and consumer purchasing goes up, right? And then we have an increase in aggregate demand because aggregate demand is made up of consumer spending and investment spending, right? What is one of the trade-offs? Well, one of the trade-offs is price increases, right? So that's the trade-off. And vice versa. If the Federal Reserve decreases the money supply, right, we have a temporary increase of interest rates. We have a decrease in our quantity of investment and consumer purchases there. And we have a decrease in aggregate demand, GDP, and price level decrease. So the reserve requirement, what is it? So the reserve requirement or reserve ratio is the percentage of deposits that banks must hold in reserve. So it's the percent of money that they cannot loan out. So any money that gets deposited into a bank, the bank has to keep a certain amount of that money on hand. So why? The main reason is so that the banks can stay somewhat liquid and they can meet depositors' demands if they come into the bank and say, hey, I want to withdraw money, I want to do this, right? Or if you have a run on banks in that type of situation, there is money for people to access. Okay, so banks aren't loaning out all of their deposits. They're only loaning out a percentage of it. So banks keep some of the money in reserve and loan out the excess reserve. Now that money that is loaned out will eventually become deposits for another bank that will loan out their excess reserves. So it works much the same way as if you get $100, right? We talked about in our fiscal policy, you have a marginal propensity to consume and a marginal propensity to save. And if I give you $100, right, if your propensity to consume is 80%, I know that you will spend 80 of those dollars and save 20 of them, all right? The same thing kind of works with the bank. If you give the bank $100, they are let's say the reserve requirement is 20%. It's not, but let's say it is. The bank has to keep $20 in the bank, right? And then it can loan out $80. And then that $80 gets put into another bank, and then that bank has to keep 20% of that 80, and they can loan out the other 80% of that $80, et cetera, until that money is eventually gone. So if you're asking yourself, wait, so there's a money multiplier with monetary policy as well? Yes, there's a money multiplier, and it's 1 over the reserve requirement, which is a very simple equation, right? So if the reserve ratio is 0.2 and $2 billion is added to banks, how much does the money supply increase, right? So, well, we know that the reserve ratio, 1 over 0.2, so we know that the money multiplier is going to be 5. It would basically generate $10 billion, right? Or increase the money supply by $10 billion. I know you're asking yourself, where the hell did that money come from? Welcome to the world of fractional banking and the creation of money that doesn't exist, but it does, but it doesn't. So, using the reserve requirements, there's a recession. What should the Fed do to the reserve requirement? And you have to explain the steps here. So, you would decrease the reserve ratio. Well, you should pause this and answer these questions. But so go ahead and pause the video and then come back. All right. So we're back. If there is a recession, what should the Federal Reserve do to the reserve requirement? Well, it should decrease the reserve ratio. And then we're going to explain the steps. So decrease the ratio. Banks hold less money and have more excess reserves, right? So they're able to loan more of their money. Banks create more money by loaning out more of their excess, and money supply increases, interest rates fall, aggregate demand goes up. There's that 3-step transmission that we're talking about, right? If there's inflation, what should the Fed do? Well, the opposite, right? It's going to increase the reserve ratio. They want to slow the amount of money, right? So banks hold more money, have less excess reserves. Banks create less money, and money supply decreases, interest rates up, aggregate demand, or GDP, down. Okay? All right. And we'll practice these. If you're wondering, well, that was really fast, I'll have another video where we practice these. All right, the second one is the discount rate. So the discount rate is the interest rate that the Fed charges commercial banks. Okay, there's what we call the federal funds rate. And right, so banks borrow money from one another, and then banks can also borrow money from the Federal Reserve. However, the Federal Reserve would like banks to do their borrowing between banks. Right? Remember, the Federal Reserve is the lender of last resort. So the discount rate is the interest rate that the Fed charges commercial banks. So if Wells Fargo needs $10 million, they borrow it from their regional Federal Reserve lending facility, but they have to pay it back with 3%, right? And sometimes, they may make it, 0%, or, Europe and things like that, they're talking about 0 or negative interest rates and those types of things. And we'll talk about those later. So to increase the money, if you think about this, to increase the money supply, would the Fed increase or decrease the discount rate, right? And to decrease the money supply, would the Fed increase or increase or decrease the discount rate? So think about it, and then answer. Okay, let's see how you did. To increase the money supply, the Federal Reserve should decrease the discount rate, right? And to decrease the money supply, the Fed should increase the discount rate, right? And that makes sense. So if you want to make it easier to get money, right, you decrease that rate, easy money policy, right? You decrease the rate, and banks are able to borrow money from the Fed and then loan that money out, et cetera, and vice versa. All right, last one, and this is probably the most popular way that the Federal Reserve can really stimulate the economy or have an immediate effect on the economy, is through its open market operations. So the Federal Open Market Committee, the FOMC, makes purchases and selling of bonds on the open market. This is the most widely used monetary policy, right? So the federal bank is the one buying, and the federal bank is the one selling. So imagine, right, you're the Federal Reserve, and you want more money, you want to increase the money supply, right? And you're the Federal Reserve Bank, and banks are looking at you, and you say, do I buy bonds from those banks, or do I sell bonds to those banks, right? And you want to put money into the society, right? So if you said to increase the money supply, the Fed should buy, correct, right? So the Fed buys government securities from banks. The banks give the Federal Reserve the bond, this government security, and what does the Federal Reserve give to the banks? That's right, money. And vice versa. To decrease the money supply, the Fed should sell. They sell them bonds, and the banks give the Federal Reserve money. The Federal Reserve takes that money, and it's no longer there anymore, right? It's gone. It's there, but it's not there, right? So how are you going to remember this? Easy way to remember this: buy big, right? You want to make the money supply big? Buy. You want to make the money supply small? Sell. And then last but not least, we have what we call the federal funds rate. And the federal funds rate is the interest rate that banks charge one another for one-day loans of reserve. So usually the discount rate is higher than the federal funds rate, right? And that is done because the Federal Reserve would rather have banks borrow money from other banks. Now, this is just a federal funds rate. This is just what they would like banks to do. It's still between the banks. This is not a mandate. The Federal Reserve cannot mandate it. They can control it through open market operations and such. But then again, it really is left up to the individual banks and the agreement that they make with each other. So it's not a mandate. It is a suggestion, and that suggestion is very much appreciated when it's used. It's one of those things, kind of like you don't have to do it, but, we're the Federal Reserve, and we said this is kind of the rate we would like you to have. So if you don't do it yourself, we'll just make you do it, right? Through open market operations and other, discount rates and things like that. They can influence the interest rate. Okay, that's all we have for the shifters and how the Federal Reserve affects interest rates. I'm tongue-tied. We will, in the next few videos, go over some practice examples on how to use this and how it works, applying it. Okay? Until then.